welcome to another episode of Duck It. This one has been a work in progress for about 2 months. We've been trying to make this happen since before the holidays. So first of all, thank you very much everyone for coming. Really appreciate it.
Thanks, Chris.
So today with us we have Steve, who's from DUCKLIFE, but today he's wearing a different hat, even though he's wearing a DUCKLIFE hat. He's here to represent Bitcoin or crypto in a nutshell. We have Mark and Nadine from Sarwa, and we have the boys from Stake, which we had from the last episode, Rami and Manar. So why are we here? Why do we have such a big crew? Well, 2 months ago, I posted on LinkedIn and I asked a question to my network, to my audience, which was a very simple one. If you could only see 5 years ahead, and if you had a bit of disposable cash to invest, what would you invest in and in what priority? And I asked this survey while giving a multiple choice between the market, real estate, and crypto. And the participation was a bit overwhelming, quite divided. Discussions went offline, and it was quite a heated topic. And so we decided, I think all of us together, that maybe it would make sense to provide content and a session, a podcast, that would inform our region about investing, because we all at least agree on one thing, and that is that people don't know squat about investing, especially in our region vis-a-vis other regions. And so there's a huge gap. And so to begin today, I'd like to go around and I'd like to get everyone's perspective and how they would describe their asset class, if we can, if we want to call Bitcoin an asset class to begin with. But Steve, yeah,
not gonna bite.
So Steve, if you could, in a nutshell, in 20, 30 seconds or less, could you just tell us what you think crypto is and how you would define it?
Sure. So hopefully everyone listening has heard of Bitcoin, blockchain. But in essence, blockchain is a decentralized digital ledger, and things are built on top of that. So Bitcoin itself is in effect a hard fixed cap supply. It's decentralized, which means that nobody owns it, so no one has control of it, and it operates on the blockchain. It's a form of currency, but its two core value propositions are that it is a store of value, an appreciating store of value, 4 million to date. 4 million % today, and it is censorship resistant, which actually is probably a topic that we should talk about more, because the censorship resistant part of it is probably something really important when we think about what money means to people and their personal wealth. So, those two core value propositions are really how I describe Bitcoin. The overall crypto industry as a whole, it's Bitcoin and everything else. The everything else part, you can almost view it as, early stage startups, VCs, speculative kind of betting, but getting in early as to what can succeed. Some are amazing, some less so. I'm a Bitcoin maxi, you could describe me, but I appreciate all the tech that's been built on top of it, but I'll go into more detail.
That's a long 30 seconds.
You said 2 minutes from the start.
All right, Mark and Nadine, how would you describe the market?
So Mark, I'll let you cover it after. But on our end, what we believe in is focusing on what we control and thinking long term. So we believe in diversification and keeping your costs low and having a long term view and starting very early. So really excited about this session because one of the main takeaways is, I won't give any spoilers, but our view basically is take a pot of money, diversify it across many countries, many industries, many companies. There's a lot of research that we're very grateful to have to benefit from that. So companies like from Apple to Tesla to Tencent, Alibaba, you name it. So I'm conscious of time, so I'll pause there.
He said everything that I would say, and it basically boils down to diversification. I think we're purely about investing, but what we like to call invest smart, because ultimately there's a lot of research that backs it. That again we show in our educational pieces and content about the importance of diversification on long-term returns.
Cool, thank you.
What's real estate?
Real estate.
Bricks and mortars,
tangible, long-term, stable. Bought at the right time and place, it could be a great asset. I think there's a huge affinity to real estate in our part of the world. But I think the reason why we founded Stake is people were buying it the wrong way. And we think that, there's huge value in buying real estate if you have a long-term view, and it gives you that stable income coming in that you can forecast based on rental returns, capital appreciation. I think
It's the oldest asset class in the world, and it's preserved wealth and grown wealth, probably the most out of all three. You have the latest one. This one has been around also, but the public markets are fairly, new. And when you look at centuries and stuff, real estate is what preserves family wealth, and still continues to.
But like time is going to be a
Yeah.
time in market. Time alive in market.
Well, thank you very much. To have our first debate, I just want to set the scene a little bit. There are two parts to this debate. There is a shorter timeline, a look at a 5-year stretch, and there is a longer timeline. Let's start with the 5-year timeline. I'm super naive. I know nothing about investing, and I'm imagining that I might represent the vast majority of the people that might listen to this podcast, or at least represent the reality of the people on the ground. And so, if I were to look at 5 years, the next 5 years, I want to invest some money. And I can only think within the context of the next 5 years. And that means being able to invest some money, take out some money, and have access to it in the short term. I'd love to get your perspectives and in terms of what you think the pros and cons are of your asset class that you represent here today. So let's start with crypto. 5-year outlook. How would you describe Bitcoin?
So 5 years long term, given how the market is, so I will openly admit that. But I think, there's two things. So when it comes to investing, I think when you actually realize that investing is a really good thing for you overall, in terms of way of preserving and growing your own wealth, I think it doesn't matter really what asset class you go into. I think you need to have a good understanding of what the asset class is that you're looking at investing in, what the companies are, what the properties are, the location, what Bitcoin is. You have to have a fundamental understanding of what it is that you're investing in. So taking the choice to invest is step one, and if you do that, that's amazing. And I think a lot of the world doesn't really understand the value of investing. Mm-hmm. The world understands the value of saving. And that's where Bitcoin probably comes in when we start to think about, why would we save in a world where money is depreciating at an exponential rate, and the return in your personal bank is diminishing rapidly, negative in places. Whereas Bitcoin is an appreciating store of wealth and asset class. So over the last 12 years of its existence, it's risen obviously ridiculously 4 million%. Anyone who held from day one to now is done very well. They've got super strong hands, or they're just not here.
But to that argument, I've been in crypto for
less than a year, right?
Yeah, less than a year, but I've almost 4x my money since I've gotten in, right? But at the same time, although that's an amazing gain and I'm so happy, it scares the shit out of me because as much as I earned it so quickly, there is still a piece of me in my heart, right, that makes me feel like tomorrow I might wake up to a negative, 400%, 4,000%. I think, what's your view? As you said, 5 years is super long term when it comes to crypto. What's your view for people like me who, from the outside, and even having invested a little bit recently, although the gains are amazing, I can't sleep at night sometimes thinking about crypto. And we talk about it almost on a regular basis. What's going to happen? We try to, look at some information, try to listen to some kind of advocates and ambassadors in the market, etc.
Yeah.
But what's going to happen? Tesla invested, Twitter invested, etc., etc. But that doesn't give me any more confidence, at least in the short term, that gain is going to sustain.
Yeah, so I think when it comes to that gain, right, Bitcoin operates in a cycle. So every 4 years, the supply is cut in half, or the mine supply is cut in half, the reward aspect of it. So there's a supply shock that enters the market every 4 years, which is why typically you see these booms and busts. Now, the long-term trajectory is obviously up, heading towards the top right, which is great. But really, to answer your question, if you're feeling overexposed or you can't sleep at night, that might mean because you are overexposed. Typically, people who trade might be over-leveraged. For yourself, it's probably that you don't have enough of an understanding as to what it is that you've invested in. So when you think about what Bitcoin offers, it's an open, transparent network. Anything that you want to know about the network, you can find out. Glassnode is a great way to look at on-chain data, and you can see all of the information about how the blockchain is performing, how long people have been holding for, how long people are in profit for, how much crypto or Bitcoin is moving on and off chain. So you can actually see, it's like an open book of a company. You can see everything. So if you wanted peace of mind, the more you dive into that data, is probably the best thing that you can do.
But there's a part of me that says that's unrealistic, right? Like, I'm super passive. I'm going to put a bunch of money and I'm going to forget about it.
Yeah.
Is that, I mean, that's how I think about the market as well, right? I'm going to put money into a fund or whatever, or, you know, a stock or whatever, but I don't want to trade actively. I'm going to be super passive and I'm just going to forget about it. And so that makes sense, and that's kind of the expectation of, I would say, what Sarwa was talking about, but I kind of feel like that applies to crypto today.
Yeah.
But the difference is that volatility is what makes people unable to have that kind of approach to how they invest in crypto.
So the on-ramps to crypto, and I think the on-ramps in the region have started to improve, but I don't think they're necessarily where they are perhaps in the West, and especially in the US, in China, and in the UK. But you should and you can dollar cost averaging. So I think when I first introduced you, I was like, yeah, you should DCA.
And that's what I do now. I do
Because
like
it's
regular,
Yeah.
twice a week.
Exactly. So you regularly invest in, and you know, small amounts that increment and grow in size.
Cool.
But you're also kind of, you know, what the Bitcoin network needs, which is you are a hodler. And the hodler aspect is if you hold on to something long term, you know, all of the data tells you that the trajectory is up. So it doesn't really matter when you're entering the market. If you're averaging into the market over a long period of time and you're determined to hold for 5 years plus, you are going to be in profit based on historical data. Now, historical data is no guarantee of future returns.
Disclaimer.
But at the same time, like if you were to do a risk-reward split of that, you would say that it's in your favor, which is how I view it. So for me, I've been in Bitcoin now for just under 5 years. I came in during the 2017 hype. Don't get me wrong, I came in because I thought, here we go, I can get super wealthy really quick, got really burned. But then when I stepped back, I actually understood what Bitcoin was and the problem that it was trying to solve and the way the world was operating. And you know, a lot of what we talk about at DUCKLIFE, that aha light bulb moment was the thing that made me go, I'll just hold this for 10, 20, 30 years and you know, that will grow exponentially as a return. But every day, 2 hours a day, I'm studying and understanding the value of what Bitcoin offers. It's 2 hours of my time. It has been for, you know, nearly 5 years. So I have so much conviction in the space, but at the same time, I do believe that your investment should be completely diversified across different asset classes. You know, what these guys want to talk about, you know, within property as well. I think there's a time that you decide when you go in. And that's the whole cycle aspect when you can actually benefit from the crypto boom and bust.
Yep.
All right. Cool. Thanks. Go for it,
Please.
Mark.
All right. So on the areas where I'll agree with you, and I think there are some great points around the role of savings. You know, how many of us know a multi-billionaire, millionaire that grew their wealth from a saving account? Not that many, right? So investing is definitely the way to go. But before that, I would say, first of all, I would question, why are you limiting yourself? Do you really need to limit yourself to 5 years? We live longer than ever, 70, 80, 90, hopefully more. So why are we thinking short term in the first place?
That's a good point.
So I would really please stop thinking short term. It's such a rookie, first time investor way of thinking.
Resembles my profile.
Yeah, and I say it just because you said it, by the way. I don't mean any
No
disrespect.
disrespect.
But
So-
it's also society today, right? Like that
Yeah,
conditioning of short term.
Yeah, but
You
let's
shouldn't
But that's what
we
we
don't
need to
like it.
shift,
Like,
right? That's
yeah,
what we need
exactly.
to
correct.
change.
It's all about instant gratification, get rich quick. But the wealthy,
Yeah.
we all know there's a knowledge gap here, and that's what we're trying to address. So as much as possible, really have your goal, try to define your time horizon, not pick an arbitrary number. A goal is retiring at a certain amount of age with maybe your spouse and a certain amount of lifestyle. So don't limit yourself, but have your goal guide your horizon, not your horizon leave you somewhere and then having to decide where I want to be. So for example, if you want to retire early, and let's say you want to retire at 40 or 45 or 50, it doesn't matter. Then what you're looking for as much as possible is actually certainty that this goal is going to happen. I need to know with more than 95% confidence that I'm going to be, or maybe 99% actually, there's a lot of models that allow for that certainty, that this goal is going to be met. And as an advisor, that's my responsibility to my customer. I need to make sure that they're in the right portfolio and the right certainty. So of course you're going to be worried about volatility. It's scared the shit out of you because it removes the reality of your situation. Is this money?
my dream in peril.
Of course,
absolutely.
of course. So we don't like volatility, especially first-time investors. It's the enemy of a first-time investor because it might scare you. You might lose a lot of money. You might pull out and never invest again, and lose out on the whole potential of investing in the first place.
So what's an ideal horizon?
The longer, the better. Our favorite customers are the ones that perform the best are 10 plus years. So. Yeah, sorry, go ahead.
Sorry, I don't want to interrupt.
No,
but
please.
there is a direct correlation between the length of your investment and the risk that actually and the returns. So it's all really directly correlated, and the longer, the better.
Yeah.
A part of me can't help but think that this short-term horizon, though, I put it out there, I also think it's a regional issue. I think that it's a cultural.
100%.
Of course,
Yeah.
financial
Yes.
literacy is not up to
It's a
par.
human issue also.
But
not just that,
I would
Times
add,
into
yeah,
the
it's
UK
a bit of an
are-
international.
People's psychology is completely changed. It's not just.
But when I look at
it's that instant
the
gratification.
Gulf
type of-
specifically,
But even
also,
here, with
the
real
Gulf
estate here.
specifically, I would say that it's even more concentrated
Oh, yeah.
here because of the, most people don't think 2 years in advance here.
Yes.
Right. And so I think that plays to the weakness of kind of the Gulf setup for I think expats at least, right? I think if I would compare, myself to my sister, for example, my sister is in Montreal. She's Canadian. She's living in Canada. She works in Canada, and she's a lot more long-term minded because she is where she is from, and she has a profession and makes money in that location. Whereas somebody like me, I am not from here. I'm here on a work visa, and I'm earning money, but I don't know how long my horizon is in this geolocation. So on the basis of that, knowing that, and knowing the Gulf. Although I completely agree with you, it's a very hard mindset shift because everything else is quite short term, generally speaking, or unpredictable.
And to add to that, you don't have a pension, so you have to build your
top of
own
it.
You have to build your
DIY
exactly.
pension.
Exactly.
Exactly.
So I agree with the difficulty, and it's even more important for you to play right because no one else is looking after you when it comes to your retirement.
Yeah, and to
Yes.
educate the market, which is what we're doing here. I think that's a big piece. And going back, let's go back to saving. We know for a fact that here, there was a recent study, I think by the bank's not going to mention the name, that looked into that, and we have 60% of people that don't have savings in the UAE. That's the UAE, just specifically this market. Go across, it's the same psychographics that you see across the region, right? We are a spending culture, we're not a saving culture to start with. So that's the first thing you want to tackle is start budgeting, start building towards saving before you invest. So we always say also look into building an emergency fund because the recent pandemic, what we've seen is a lot of people losing their jobs and they didn't have anything to fall back, a safety net to fall back on. So that should be your step zero. First, build that emergency fund. So again, going back to education, we want to start at this point. Beyond that, you want to invest because, and I think we all agree on this, if you're not investing, you're actually costing yourself money. You're losing. And this is the
100%.
only way that you can grow your wealth. There's actually a very interesting study by Harvard done, I think, a couple of years ago. We had the study on one of our webinars that looked into the cost of what is that foregone return if you're not in the market, and it puts it at 4.3%, I believe. If you're not actually investing, you're losing 4.3% of the value of your money, and that's a big thing. So going back to what you were saying, just start is the first step also towards investing, and then do your research and look into what makes sense for you.
Completely agree.
Yeah.
What I was about to say is not to completely discard your question of the 5-year thing, because I think it takes a lot of framing to say, rather than say, should you invest in this versus that versus this, it's what you should allocate perhaps a little bit more to be more overweight in, given, although we all agree on, I think around the table, is that nobody can time the market. We're like, nobody can predict the future, so let's not kid ourselves. And this strategy and this mindset shift, this psychological kind of shift in the way you got to think about investing 5 years, 15 years down the line and so on, small amounts, compound interest, averaging in, dollar cost averaging in, and those sorts of models that work beautifully to get you to your target objective. I think that construct, of course, it takes a lot of education to explain to everyone. And in the diversification aspect, absolutely, we can get into that. But in terms of, if we were to go back to your question, without trying to time the market, what should you be, perhaps the right way of framing the question is, if we were going to talk about a 5-year horizon, what should you be more overweight in? And that's when you kind of get into a bit of discussion of where are things today? And that's where
So
we'd
let's
like to
take it
direct it back to us here on the real estate side, because we're the the undervalued place, I think. I don't think you find undervaluation in either one of the public markets or Bitcoin. And that's where we want to make...
The money printers go.
Exactly.
So it hasn't really spilled over I'll just give some basic kind of background or landscape as to what's going on. You guys know there's a lot of money being printed across the world, and it's the pandemic has accelerated that, and it's found a home in the financial markets, and it's spilling over to inflated valuations. And you probably know better than me, and you guys, I think I heard this in one of your old webinars, the dog and the leash, that the dog is way further away from the owner, and that's probably when prices of assets are significantly disconnected from the fundamental value of the businesses. Short term, exactly. So and you can choose really to completely ignore it. You're right, Nadine, because no one's going to time it right, and if you just invest over the long term, you end up being a winner because markets always grow. It's as basic as that. But if we were to make this a little more competitive, to say, hey, if I wanted to be overweight one asset class, I think there's a lot of merits to be in real estate today, in Dubai real estate specifically, when we're looking at cyclically where we are. But I think one of the things we should also, in terms of basic awareness and financial education, take a step back and look at basic principles. We've been talking about those, savings and so on. But return, expected return and expected risk are the things that usually you analyze assets based on. Real estate has had historically the same expected return as public markets. There's not enough history with Bitcoin, but there's studies that have shown that real estate have, through centuries, performed equally to public markets, but with less volatility, so less return. Less risk, excuse me. So in that sense, it's looked at as a more stable asset. So that's a basic fundamental analysis that needs to be done when we're trying to educate people with regards to the differences between the asset classes. And within this, you got to, I think, internalize it and understand what is your objective when you're investing, what is your risk tolerance. So if you have a higher risk tolerance, you can go after more risky assets. But if you have less risk tolerance, the way you put it in terms of whether you sleep at night safely or not, it warrants maybe a shift in the portfolio construction that you have. And this is, the kind of advisory business that you're in, Mark, right? So you tell people based on their risk tolerance what they should be investing in. So those are the things that I think need to be brought out to the surface when you're talking to people.
But when we're talking like 5 years,
Yeah.
I think the whole notion of the question and the discussion where I wanted to take it, if you know that your horizon is 5 years, then what you're looking for is the quickest return within those 5 years. Right?
No,
Or the
Not,
best
not,
return
not
within those
quickest.
5
No,
years.
no,
That's
not
not
quickest.
true.
It doesn't need to be the quickest.
I
Yeah,
agree.
I think
Or the best return.
If I'm
Best
55,
and maybe
Better
maybe
framed.
safest. I mean, I think people today in the pandemic are a lot more careful with their money. So
Yeah.
maybe it's not the quickest, but it's something that's stable. As you mentioned, a lot of people right now potentially got salary cuts, lost jobs. So I don't think it's quickest. I think people tend to think, okay, how can I keep my income or keep my investment safe and that recurring income coming. So. And I see that right now because a lot of people are looking at real estate now because they know it's at the lows. They're looking at it not only because it's the lows, because they understand that, okay, listen, whatever happens, if I put some money behind real estate, I know that it's going to be rented, that, the pandemic showed that regardless of what happens, people need to pay rent, they need to stay in a house. So I agree, like it has to be not quick, but safe, stable. And, even if you're looking at a 5-year horizon, it needs to
And also the
fit that.
compounding aspect of it, right? right? Like
Yeah,
quickest
exactly.
the quickest is the guaranteed way to lose money.
100%.
Because you're emotionally
Yeah.
driven when
Yeah.
you're investing your own money. So you will make decisions based on emotions rather than rationality.
Yeah.
So yeah, I think that stability, that long-term time horizon, and the compounding aspect of it. Because you know, what is it? I don't know what wonder of the world it is. But
Yeah,
like,
yeah.
in effect, compounding interest is the one of those great
Einstein,
wonders of the world. That's the
We've
one. Like,
memorized it.
you know, it's of huge value to you. Now, you know, how do you compound that? You know, once you've compounded, you know, a certain wealth and build up a portfolio, then you can diversify out and then compound further. But you should never, I would never take a 5-year time horizon and say that's a good plan. You've got to look at kind of, to your point, your entire lifespan and say, okay, where do I need to get to? And at what point do I need to get there?
Exactly, and a lot of the magic happens in the last 5 years also of, let's say look at all of these graphs, whether it's, you can find them on a lot of websites where you're calculating if I invest at this rate, and you, every time until today, every time I look at it, I'm blown away the difference between a 25-year or a 30-year.
Yeah, so true.
It's
Yes.
like,
It becomes
it's
expensive.
crazy.
yeah.
You're doubling. It's the difference between $1 million or a $2 million retirement.
So I think you guys now all agree that the question is wrong and the timeline is wrong. Point taken, thank you.
No, it's,
But to summarize, just for the naive guy sitting in this chair, if I were to make a bet on the best assets to perform within the 5-year horizon, which one, I mean, you're all going to say me, but which one do you believe would be the
I'm not gonna say me. No one knows. I'm gonna tell you. He said no one can time the market, which is basically figuring out is today better than tomorrow, and the answer is today always. It's time
To
in the
start.
market. The other thing I'll add is, it's not, people can't just time the market. People can't beat the market. So that's a really key thing to understand. It's not just that you're not in the industry. Even the best people in the industry have no idea what's gonna outperform.
course. Yeah.
Like, so ignore the forecast. It's all bullshit. So even
Can
if
you
you,
show me that curve on my dashboard?
Forecast.
because in the long term, that's why we
Exactly.
that's why we like
we
long
give the
term,
long horizon, right?
because we have we're lucky to have data since the 1920s on how these asset classes perform, right? But no one can tell you this is going to perform that way or that way. What we can, however, is draw conclusions based on what this asset class is trying to do. No one is saying put all your life savings in Bitcoin. Like, people have killed themselves because they did that, right? But if you are interested in this technology and it's proven to stay after a certain amount of time, and you want to speculate, you're into it. Yeah, sure. Put
Speculation. Here we go. Right.
yeah. Sorry, I had to wait for the right moment.
Tangent, come on.
But that, sorry, I went on a tangent. But
Sorry.
but yeah.
Okay,
So,
so
but
You're
It
right.
boils
what I
down-
would say, just sorry, go ahead and please.
It
you guys
boils
finish.
down to diversification. Again, let's go take that step
Exactly.
and think about, ultimately, when it comes to investing and the research that's behind it is about the correlation between these class assets, right? When we're talking about the projection towards the future, we're talking about these bundled class assets because ultimately the global economy is trending upwards. I don't like to say the market is moving upward because there are markets like the Japanese market and so on that either went down or stagnated, but ultimately it's the global economy that's trending upward. So as long as you have a portfolio where you have different class assets from different geography, different markets, and you are well diversified in your approach to investing, you can sleep well at night.
True.
Now, again, if you want to, take more risk in certain class assets, and I'm not going to mention, but you can do that, but don't do that with the bulk of your investment. Don't do that with your life saving. Do that with a small percentage. Make sure you're balanced, So that's going to help you. That's going to remove the emotion out of the investment.
100%. And then you'll invest a lot more comfortably, knowing that your whole portfolio is diversified.
Yeah.
And I think getting that basic principle out as well in the early, before we get into a little bit more about the relative value versus, what our asset class or Bitcoin or public markets can give investors if they go overweight at this point in time, which is something which I would like to briefly touch on because educating the market about the differences is important as well. your field, the Bitcoin field, is extremely. I'm trying to educate myself in. By the way, it's fascinating. I find it fascinating. It needs a lot of domain knowledge, I think, to really understand the mechanics of it and the value of it. There's a lot of pros, and there's a lot of cons I still have as well. But I'm getting over a few of them gradually.
Just list them out. That's probably another episode.
But getting into the pros and cons of real estate briefly versus the other asset classes, I think it's worthwhile, as Rami mentioned, to highlight that, the uniqueness of what real estate provides is that it's a tangible physical asset that has a productive use, that is kind of operates a bit in the uniqueness of it is that it operates a little bit like a stock, right, with the capital appreciation and the growth in value of it, okay, and like a fixed deposit as well. So you have the stability of the fixed income that's coming from renting. So it's the components of the return are made up of running income from rental yield, they call it. So renting out the property and making a passive income from that, and growing the value of that asset with time. And I think just like the markets are going to benefit from the current economic conditions of printing money, which affect the currency value, which affect inflation and all that liquidity that needs to find a home. You do have to put your money at work somewhere that's going to benefit from these trends, and public markets as well as Bitcoin is a beneficiary of this. But there's all the more reason to be in real estate, and I think overweight, just because we are at a point where it's not inflated, unlike you guys. It's really
inflated in the UK for a number of years, but
And other markets.
Depends on the market.
You're timing the market. You're basically putting a time on where we are in the journey, which is a very bold statement, and people have been proven wrong. Like let's take back to COVID, right? Like just before we were in March, we were in full lockdown, and everyone was like saying, "Yeah, let me stay in cash. It's overinflated." And then the people that stayed in cash for the second quarter, third quarter, all of them, including institutions, not just first-time investors, very smart people, because they were saying it's already high, it's gonna correct. Oh, didn't correct, and that happens over and over again. So I just
there's an inflation trade, yeah.
I just be very cautious, saying we're at an all-time high. Of course, as Nadine was saying, the government, everything is pushing towards everything trending. To the right.
We did the podcast at the start of last year, right? So, and this was just as everything had rolled over, and we were talking, and then you and I definitely agreed that we were like, you should invest. I think at the time I was taking a position like it could roll over more, but then realized it was very quick to realize that the amount of money supply coming into the market. Once you understand that dynamic of what that does, that the speed, so velocity of money, the speed of money transacting and moving around the system, was going to collapse because everyone was at home. But the amount of money supply coming into the market was enormous. What typically happens, and like when that happens, money gets deployed into asset classes. So I think a lot of people were caught short. We were fortunate enough to start to realize what was actually taking place and where to shift that capital. So I think that's an important lesson for anyone when you start to think of what do you do with money? Do you try to time the market? Never try to time the market, but also investing your money and capital and putting it to work for you is a critical part to growing wealth, retaining purchasing power, and staying in the market for the long term to benefit your overall lifespan and your future generations. That is such a key takeaway that many people don't recognize.
So let's shift the conversation a little bit. Let's have a more heated debate. Okay? So I've just been educated.
Nice.
My horizon has now shifted. I'm now a bit smarter. Let's look at a 15-year plan, right? Is that suitable?
I think Bitcoin isn't even about
15-year plan. 15.
15-year plan.
Okay.
15-year plan.
Yeah.
I'll be 50. It's perfect. I want to retire, right? I have a low to medium risk appetite because of the circumstances that we're living. And I probably represent the majority of people today. They probably sit within the medium to low risk, probably even more low risk. Now, I have a certain amount of cash that I'm ready to invest now and over the years if I want to average it out. But generally, what would be your position in terms of representing the asset class that you're here for today, in terms of where you think it stands in its performance vis-a-vis the other people that are here today?
Can we just talk about risk for a minute?
Sure.
Like risk tolerance and like what
Yeah.
your risk tolerance is, because I think this is a really important piece. So when we talk about, and you guys, I don't know if you'll agree with me. Let's see.
Yes.
Let's have
We're
a
not
debate.
supposed to, just
No.
let's debate.
So when you think about risk tolerance, the younger you are, the higher your risk tolerance can be.
Yeah.
Unless it's COVID.
It used to be like that. It used
that's
to be.
what
Why?
I'm-
Why? No.
Well, I'm speaking from my wife here.
He has a scientific, quantitative method of defining risk. The
Yeah.
more time in the market, the better. You can take over more
Exactly. So you can
cycles.
absorb
Because it will
precisely
balance
that.
out on the long term, right?
sure.
Whatever you incur as a cost in the short term, it's going to balance out.
But I agree with you,
Again,
Chris. I
depending
think
if you
in
have
COVID,
emergency
people are a
funds.
bit more, even the young. I don't think it's not dependent on age. I actually think people today are a bit more risk averse.
Okay, but like let's take COVID. Let's forget COVID for a second. If you talk about risk overall, like
Yeah.
your risk tolerance, the younger you are, to Mark's point, you have longer cycles to go through. So you can actually you can take on more risk the younger you are,
Correct.
and
Yeah.
then you decrease your risk the older you get. As you start a family and you have mouths to feed, like that's where you start.
But we're
to decrease.
mixing two kind of mindsets. Right?
Yes,
We're assuming
exactly.
that we're young and we want to retire at 65 like our parents. Or retire at 65. I want to retire at 40. 50.
The younger, the better, though. But I think we're drawing upon the difference between quantitatively versus emotionally, which are both probably as important. And the emotion can even take over.
Yeah, true.
Like that's where in our case we don't just look at horizon. So back to your question, horizon, it leads with time horizon, but behind it, I'm curious to see who's your audience on LinkedIn or the people that answered the
I
poll.
think it's generally people like us, right?
Yeah, but are we educated financially? Probably, if we're sitting here talking about this. But is it someone that has no idea what an ETF or an index is?
I would
Because
say the majority of the audience that we're speaking to, especially on the survey that I did, are not educated financially.
yeah,
And
then
you got two different results also,
Yes.
which you didn't clarify at the start.
I didn't clarify. When I did it on Twitter, I had a result. When I did it on LinkedIn, I had a
Different
result,
audience. It's interesting.
Right? And
Very
so different
interesting.
platforms attract different types of, I guess, people. But anyway, on Twitter it was pro crypto, and on LinkedIn it was like pro market and stuff like that, right? And real estate. So-
We all surround Jack Dorsey as like Bitcoin.
but generally speaking, I think one thing is COVID made us extremely emotional. I think we're like risk averse to some extent. We're a little bit afraid of what's going to happen. We're
There's a
uncertain.
famous quote about that.
Go for it.
Be greedy when others are
yes,
Be fearful when others are greedy.
love that one.
Yeah, that's really important.
We're just
Not to
scared.
time the market.
That's really good because last year, I actually posted this last week, so I'll reuse it. But the main emotion was fear, right? Our message was don't sell, stay invested. Now it's the flip side. Now it's greed, right? People are just sometimes skipping the saving checklist and going straight into investing because they're just seeing all this hype.
High returns.
So it's really important to avoid this. Back to your point, to avoid being when things are looking scary to sell out. On the contrary, keep buying or stay invested. And when things are looking too good, or in your perception, because it's all emotions, at least you can stick to your plan, but avoid again taking out credit and over investing and or being sloppy along the way.
Never borrow money
To invest, that's
unless you're buying a property where you're going to have a mortgage.
well,
But
actually,
don't
if you're gonna live in it,
credit cards to
fine.
buy Bitcoin, like that is a terrible idea. Definitely don't do any of that.
Yeah,
Just to unpack why, the credit card, for example, will have, I'm not sure what the latest one, I'm out of it, but between 15 to 20%, let's say, a very strong market performance, let's say in the last 5 years is 9-10% in a growth portfolio. So you're guaranteed basically to lose out by using your credit card to invest. And that's a common question we get and why we don't recommend it.
Okay, so to kind of refocus a little bit.
Yeah.
15 years.
Longer term horizon, 15 year plus. My demographic, right? Not intellectually kind of or financially educated enough. medium to low risk appetite
I know what you
investing.
guys
Which of you will perform best, and how would you split and diversify, right? Amongst, or do you even put money in everybody's kind of mix? I'll let
Best is a strong word, right? To put in it by itself. Is it
But
best, risk adjusted?
what's good content though?
I'd much rather.
The majority.
I'm a lot more certain about, and without going into it, I appreciate completely that nobody predicts the future and so on. I was only making the point before that, when you're this low in our cycle, the real estate cycle here, that you have very little downside risk. When you look at indicators like recovery value, replacement
below
risk,
replacement cost. You
cost.
can buy stuff today cheaper than it costs you to build.
And in terms of risk, we all I come from a finance background. There is generally a recovery value that you look at when you invest in equities, and it's pretty much zero. A business can go bust, and your investment can go to zero. If you look at your entire risk, the maximum worst case scenario, if you invest in one, that's why diversification is super important. But a bond, for instance, right, gives you a 20 to 30% recovery risk because there's some hard assets that are ultimately that the business, if it goes bust, is going to be able to sell, right? And in real estate, the recovery value is the highest out of all these, out of these two asset classes. The intrinsic value in Bitcoin, you'll have to excuse me, I have no view on it yet. But the point that I was making is that I was able to answer that question a lot better when it comes to 5 years, because we're at the point in the cycle where we can't go much lower from here. It's not sustainable. And there's in terms of supply demand dynamics in Dubai, they're cutting supply completely. So, demand is going to bring back, the turn in the cycle with all the other factors in place.
In some areas, prices are starting to come up, and I think
That's true.
That shows you that the market is maturing. And I think gone are the days where people, and that's where you put a longer view on real estate, people coming in, putting money on a property, expecting to make money in 2 years, sell it, and they're out. I think, buying now at the lows, you have to take a longer view, especially in real estate, or the historic lows close to replacement cost.
So proportionally.
Yeah, and again, because I've done real estate for 15 years now, so I have a natural bias to it. But what I've learned over the last 15 years is that people, and this goes back to Nadine's point, is people were buying it the wrong way. I mean, if you're buying a home, fine, but if you're investing, don't put all your money into a property. If you're looking to just make returns and make that consistent income and buying it at low prices that we see today, it doesn't make sense to buy that full property. Put some money into a platform like Stake or Stake, just Stake, where you can diversify the returns, lower your exposure, and then have some money to diversify into platforms like Sarwa and Bitcoin. And I think that's
the answer, from our end. If you had a 15-year horizon, you got to build that diversified portfolio.
Because real estate generally, in terms of my kind of upbringing and education on real estate, investing in real estate, is actually buying entire properties.
Yeah.
So now we have a small portfolio of entire properties, of which I hope to have never had made, which some of them are in Dubai, by the way.
Okay.
And so,
That's a good
funnily enough, the property we're in today, by the way, in Dubai Hills, is the highest demand you've ever seen.
There you go.
The prices are going up like crazy. You can't find a house. Rents are going up like crazy. But when you compare it to JLT, for example, prices are dropping like crazy. And so what you're saying is interesting, which is new, which is kind of, you're unlocking the potential of that asset, which is great for people like us, is that don't just invest in one property, invest in
10, 20,
30,
and
40.
continue to
The
invest.
approach of what
Sarwa.
Sarwa does exactly.
exactly.
So don't put all your eggs in one basket
100%.
because ultimately, and by the way, I just
Or in
want to
one stock,
also
or in one
in one
fund.
stock or in one class asset. So again, what Sarwa does is you're actually buying into stocks, bonds, and real estate through ETFs. So we bundle all the different class assets again into one portfolio. So it is really well diversified, and that boils down to again, the risk that you would take potentially if you're putting all your money into one, which I've done, by the way. So I come from a background of real estate too. My family business is real estate. And I bought here, and it was an attempt to time the market, which turned out to be the worst thing you can do. Again, we have so much data on do not do that. And we actually ran at Sarwa a study looking into timing the market that went from 1990 up until 2020, and we looked into different scenarios. Taking $10,000 that you actually put in 1990, and you just let it be invested in the market, a balanced portfolio of stocks and bonds, versus trying to time the market going in and out and in and out. And it was clearly the fact that staying invested brings you the optimal return. Trying to time the market, even if it's for 30 days, so there was a part where, let's say, the market's dropping 30% and going up 10%, and you're trying to time it because you see that uptake, you're like, I want to buy cheap and come in at a better price. You actually lose on around, I think the number was 22% on returns. That's massive, just 30 days out of the market. So again, to us, it's if you're actually looking to invest, make sure you're diversified. Make sure you're thinking long-term. Make sure you have goals in mind that you're working towards. Make sure you lower your cost, because ultimately it's about the net returns, right? And make sure you keep emotions in check, because you don't want to go through that crazy roller coaster of panic sell and I don't know what's happening. And make sure the asset is liquid enough that when you need the money, if you need the money, but again, have the emergency fund in place first, you can really easily access the money. So these are the principles that we actually go by.
Okay, let's try to get a real conversation here.
Hang on.
Hold on. Hold on. I got my emergency fund. I'm looking longer term, and I have cash ready to put aside and start investing. Okay. I'm still mid to low risk, and proportionally, I want to get a view of how you guys would split that money.
But so you're talking about mid to low risk.
Yes.
So these, I think,
proportionally, how much do I put in crypto?
Yeah.
In Bitcoin? How much do I put in the market? And how much do I put in a diversified?
Okay, let's spice it up.
Yeah.
Let me spice it up, because I think like, this will get like definitely these guys going, and that's these guys as well. So for me,
let's wrap it up within 5 minutes.
Okay, that's not going to happen. So when it comes to where you should put your money, and no one can say where you should put it. It should be where you're most comfortable. For me, when it comes to things like, and I'm going to shit on everyone else first, and I'm going to jump in and score one and then hand over the button. When it comes to property, I think, so what these guys are doing in terms of the democratization of property, I think that's an awesome thing, because we've been taught at a young age to put all your eggs in one basket, save up as much capital as possible, destroy your liquidity, and buy a property. That's the shittest advice you can get given
100%.
today, right? So then you look at kind of, what you can do now. So you guys giving you access there. When it comes to the stock market, of course, just invest bits in the stock market. ETFs are a great way to get exposure across a number of different assets. That's awesome. But that's also happening in the crypto space. When we look at kind of, the decentralized finance piece, there are portfolios, kind of ETF type things where you can actually get access. Now, those are higher risk in the sense of they're emergent. But what is the issue with emerging technology or emerging asset classes to actually invest in?
Unpredictability.
Unpredictability, of course, but then there's asymmetrical upside as well if you get it right. So the percentage of your portfolio that you put in is how you then balance that and what your risk tolerance is.
Correct.
For me, risk tolerance is very high. It's been that way for a long time, but then I've also had the kind of the stability of going into the property market in the UK. For me today, given the way that the world is operating, given the length of time Bitcoin has been around, it's been around 12 years, that's not a short time frame. If we'd had this conversation in 2017, you guys would have all convinced me that, yes, there's still speculation. But now you're investing into an emerging asset class that's gaining far more credibility. You have Elon Musk, you have Tesla, you have MicroStrategy, you have Jack Dorsey and Square, you have corporations, you have government entities in the US getting involved. It is naive and probably irresponsible not to have exposure to Bitcoin at this point, given the volume of money supply coming into the market, given the depreciation of purchasing power, given the fact that no one has control of their wealth because it's sovereign run. So take back control of your wealth, of your purchasing power, and protect yourself as an insurance policy against, an irresponsible central banking policy and mismanagement, at a.
I will say one thing.
So
hold on.
now
You're like,
hold on. But I will say one thing. It is still the only asset class, if you call it an asset class.
It is an asset class.
It is the only asset class today that people still say, invest only what you're willing to lose.
That's because they don't understand it.
But even the biggest advocates of it.
But isn't the same with stocks? Going back to this point over here. You can put your money into a stock market and you can lose because that company might go
But I don't think
that's
that's necessarily a negative thing. I'm not saying it's a bad thing. It just says that proportionally,
Yep.
it won't hold the majority of what I'm ready to invest. Because I'm only going to put into crypto what I'm ready to lose.
I think if you put into crypto what you're willing to lose, then that's a fair point. If you put into Bitcoin and you say, what are you willing to lose? Like, where does the data tell me that I'm going to lose that?
I don't know.
2017, like people killed themselves because
But
they
people
lost so much.
mostly all the time.
No,
Yeah,
no,
yeah,
I'm
yeah.
sorry. I'm
But-
sorry. I'm
but-
sorry.
but-
It's
but-
like-
that's why we
we're
say
going out of
diversify.
line. We're going out of line. This is a dangerous It's becoming a dangerous podcast. Like, if you are licensed and you have a fiduciary duty to protect your customers' savings, you cannot put that amount of risk in a portfolio. Back to
And I think
maybe
that's,
someone.
and that's what I'm trying to get to. The
Regulation.
proportion.
Exactly.
I'm
We
trying
need-
to get to
What about-
And
what
how
about
rich
risk?
are we? I'm not that rich. I cannot afford to put my savings and lose them. Maybe they'll do 40x, but maybe they'll go down to 0. What are we solving for here? Are we solving for someone having a realistic plan? Would you rather have $2 million with insane amount of probability, or would you rather have $40 million, $50 million, or 0? It goes back to risk.
But going back to what you said, like there's no, what you put into the market and the percentage of your portfolio that you put in is entirely down to you and your personal decision or your financial advisor if you choose to have one. Right? So,
but that's precisely, I think, what I'm trying to understand. If we assume that the majority of people within our circumstances, I don't want to generally say we're all the same, but generally, and we're all mid to low, let's say, risk appetite, in 2021, with everything that we just lived, and etc. Proportionally, I think it just sounds like if we are going to educate ourselves, that if that's your risk appetite today, especially for someone like me, and this is not advice, whoever's listening, this is not advice.
What do you want to
Absolutely.
do?
Absolutely.
No,
I'm just
absolutely.
saying, proportionally, crypto holds up the smallest piece of the pie.
it holds the smallest piece.
Responsibly.
Responsibly.
To do responsibly.
Correct.
It's the smallest
But
portion of the pie,
also-
but it needs to exist.
Hold on, exactly. But just to be
needs to
clear,
exist.
That I'll
like-
agree with.
the advice and guidance that everyone would tell you when it comes to crypto, it started off with 1% allocation, right? While it was still emergent.
Yeah.
Now people talk around, I think Chamath even mentioned like 5%. Some people have gone 10%. Go any more than that, that's entirely based on your personal risk appetite. And that is because, get down to the whole point around risk tolerance. You don't throw all your money into one basket, nor do you gamble to an extent on something that's so emerging, with, that lacks data. What I would challenge with that with Bitcoin is that it's one of the most transparent networks that you can actually go into. So if you spend the time, if you invest your time and you learn and understand the value of it, you don't need a financial advisor. You do not need a platform or anyone to tell you where to put your money because you can go and do the work yourself. If you're not willing to do the work, then you're not going to benefit from the asymmetrical upside that's there. Now, on the flip side to that, if you do want to work with people who know what they're talking about when it comes to investing, like you guys at Sarwa, you can passively invest and actually work, your money into a platform that reduces that risk. What I'm saying is that you should have some exposure to higher risk assets. If that isn't Bitcoin, that's fine. Choose a different asset class within the stock
Emerging
market.
markets.
Emerging markets. Is that even risky?
Yeah.
I'd argue
Yeah,
that,
this
like,
is considered
you go to
riskier
stores.
than
But-
developed markets.
No.
Yeah, but that kind of is entirely up to you. I would never sit here today and advocate for you to throw your money into risky assets. You have to understand them. And that's going back to the point that I made at the start. If you invest your time and you understand an asset and you learn, then you're investing. If you do not understand an asset and you're putting money into something, you are speculating. That is the
Very
difference
true.
between investing and speculation. Now, the percentage weight is entirely down to you. Me, I'm heavily, probably irresponsibly long.
As long as you know it.
Yeah, but at the same time, I know that better than I know marketing today. I could give you more advice on Bitcoin and that network than I
Now
can.
that
on
we have an
such-
announcement
You're a
to make, we're
special
starting a new
case.
business.
you are a minority in the
It's a
market
joke.
right
Exactly.
now.
So it's-
License, we're not starting it.
And should we take that passion and then build projects and actually look towards decentralization and dApps that we could actually build and put to work for the market and actually bring the market together? We should do that perhaps, but that's a 20-year time horizon. Now let's think about kind of that piece. Do I invest my time to now develop into that space? It's a passion piece. So
I think the new
we
kid
all
on the
agree
block
that-
always gets bullied, and that's okay. And with time, you're gonna show your worth.
First they dismiss you, then they laugh at you, then they fight you, and then they succumb to you.
It's a
That's
nice
basically the way that it's come. So, and the market will be the judge at the end of the day. So we'll circle back in a year and see.
Yeah.
It's a very compelling narrative. Let's put it this way. That's why it's gathering a lot. The story is gathering a lot of attention this time around compared to 2017. There are like a lot of like signals that say this time is a bit different, but
That's a very
this time
dangerous
is
signal.
different
I think
is
I would say
also
this time is different.
It's where it's headed, ultimately, going back to decentralization. But again, the fact that you have in financial institutions regulations is not necessarily a bad thing. The reality of the world, and let's be honest about it, it's not everything is ethical out there. So you do have people taking advantage of any tech that's out there, whether it's a really good tech behind it or not. There is still cases in the regular financial industry, right? But at least when you have regulators to go back to, as a small retail investor, you're protected. There is an authority you can go back to. Decentralization might be tempting, but the reality of today's world is because you have regulators, the smaller investors know that they can trust an institution. There is someone you go back to. And that's how, we operate because, again, we need that safety net around these financial institutions.
Yeah.
It could be coming. Yes,
So
but
regulation
for now,
is a really important piece, right? And I think that's what, a large part of, the Bitcoin, I don't like calling it the crypto space, Bitcoin space, like it requires regulation for more confidence to come in. Like for you guys to be able to advise and give that clarity for people, you need regulation, you need those frameworks in place. And I think that's kind of what you're seeing today. You're starting to see those frameworks start to be established at more of a government level. And as that scales, the risk is going to decrease. And as that risk decreases, your portfolio allocation, in theory, could scale up. But you need that regulatory clarity or clarification, especially for like large institutions or corporations to put the money in. 2017 was the retail investor. This entire bull market has not been driven by the retail investor. They are only entering now, which is typically a symbol or a signal of hype. Speculation,
Yes,
and when the market
classic
then
late
goes
stage.
parabolic. Now, the question really will be, does that sustain, and is this a paradigm shift? I don't know. I believe in what the problem is that Bitcoin is trying to solve and the direction that it's going. Is the price ahead of its time? Possibly. But arguably, we're living in completely unprecedented times today. So I don't think there's a clarity as to whether price is ahead of the time or whether I actually know this is the insurance policy that's going to be beneficial to everyone. There's a lot of work that needs to be done in that space. And I keep saying, if I fast track to 2030, I think I would have made a decision that will benefit generations in my family to come. But that's a 2030 outlook, which is time. Now, if I'm wrong, then halas, doesn't matter. Like there's other investments that I have. Right? But
I think that's the underlying message, right? I just want to summarize. We've been talking for almost an hour.
Wow.
If somebody has listened to us for that long, holy shit, we're really good and interesting people. But anyways, let's just summarize this, okay? I think the takeaway that the audience that I'm learning today is the following. If you have money to invest it immediately, number one. Number two, diversify the shit out of everything that you invest in, whether it's the market or real estate or even,
most important thing.
The biggest message is that diversification and invest immediately.
Sure.
Right? Now, there's just one last
less
question.
on the diversification bit to an extent, but we can go into that in more detail another time. Like I agree with diversification, just not. I don't think you need to diversify like horrendously. I think you should diversify within your control. So like if you know the market and you've got expert advisors, you do that, and then you've got property, you go into that. I don't think you should try to split across 7 different asset classes straight away. I think that's
And that's what I was going to say. I think it's not realistic to ask somebody to diversify like crazy. I think in terms of vehicles or how you do it, I just don't think it's realistic. Like I'm not going to be interested in managing multiple kind of setups with multiple kind of platforms and multiple.
You don't need to manage it. That's we
I
can
know
leave
that.
that discussion for part 2. Let's do that.
But even today, for
Yeah.
example, I logged into Sarwa to show Steve how the dashboard looks and how cool their product is. I went into the trading platform of how I'm doing my crypto and whatever. I went into my savings accounts here, and I went into another investment platform that I have in Montreal.
You didn't go on stake?
No, not yet, right? But generally speaking,
Chris, man.
that's a real bad bird. It's so unnecessary.
but I will right after this podcast. But my point is the following: the takeaway is, it is not realistic to assume that John Doe or Muhammad Ali is going to go every day and log into like 6 different platforms.
Fair.
And so today, what I'm still kind of asking myself is, what is the advice? Like, is it, majority in the market and some in real estate? Is it how much do you keep in cash? I don't think we have the answer. I think for everybody it might be a different answer.
Yes.
Correct.
But the takeaways are, invest as quickly as you can. Invest long term. Your risk appetite doesn't have to be what you believe it is, and you have to get used to understanding what that risk appetite means over a longer term and how that might change your outlook. But that's a takeaway. And if you have the courage and if you believe in the future, put a little bit of money into it, right?
Well, you're just looking at me for saying that. I mean, it's the
well,
same.
the future in terms of maybe a new asset class.
Yeah.
Is that generally where we all stand?
Yeah.
Final
Just
thing to take away
we're all
is
on.
invest your time. Like, and you know, you guys do an amazing job at Sarwa. Like, educate yourself around the topic of investing. Like, doesn't matter what you invest in at the end of the day, as long as you have an understanding. Like, the education piece is so important. Once you crack it and you start to understand it, it becomes a hobby.
Yeah.
So
Lifestyle.
like,
It's one of
that's such an
the-
important piece.
Yeah, this is a really key piece because we invest so much time on spending and the amount of time we invest on ourselves is really underwhelming. Like I think that's a really great point. It's also cool because you can learn along the way. You know, there's a really cool graph that shows the perfect investment versus just getting started, and the incremental difference isn't that much bigger. It's more important to get started, and you can learn along the way. I will caution it can be extremely boring and
Not in Bitcoin.
exactly because you're speculating. So as a guide, if you're having fun, you're speculating. If you're very bored, then you're investing. So yeah, I'll leave it at that.
One last point on diversification. We always say diversify properly. It's not just diversify, because it's not about just, like you said, just adding random class assets. It's about knowing, again, there's a science behind it. There's covariance and correlations between different class assets and how you want to do it. And this is why, again, goes back to education. Educate yourself and understand that it's not as simple as just bundle a lot of different things together.
There's a really cool chart that it would be cool if we add in this video, but it shows you in the last 5, 10, 15 years, the best, back to your question, the best performing asset classes from top to bottom. And there's absolutely no trend. It's as colorful as this beautiful office where each color is an asset class. It's just, we cannot predict it. Sometimes it's going to be one or the other. So why choose? It's so easy to buy into many things and to spread your money across. So just own the full pie as opposed to try to pick each one, but know your risk level. And there's a lot of free, and I'll put Sarwa there just because for ease of access, you can get a free portfolio recommendation or a sample, whether it's on Vanguard. There are many websites where you will know based on not just your horizon, but your emotional state and your age and many other variables, if you're truly balanced, an aggressive, or a conservative investor.
One final thing.
There's been like 5 finals.
I know, but this
Yeah.
is final thing.
We didn't get it. We didn't get a final word.
Do you have any finals? Okay.
Final thing. So yeah, final thing on
No.
because I think it's a really good point on the investing. I think we should put out some information and links, like especially when it comes to Bitcoin and the whole crypto space, just to share like information and knowledge, because I think that's a good takeaway for people to do their own work. And I would say to think about Bitcoin, think of it like the internet in the 90s. The internet was founded on open protocols, to share information and communicate. Bitcoin is an open protocol to distribute value. That's how I would say start to think and wrap your head around potential opportunity and the opportunity cost of not paying attention.
Let's share the Ray Dalio one if we're gonna share. That
Ray
was really
Dalio
good.
is like, he's been saying, he's shifted some good stuff recently.
He's his
He's
favorite.
actually dived in. So actually got the Bridgewater piece where they've actually started to look into it. It's a really credible insight, because if there's one person who's got a lot of credibility in the market, just for him to even be paying attention is great, and you should definitely spend time reading up from what Bridgewater have to say.
Just be sure you read Bridgewater's, not what people think Bridgewater is doing.
All right. Any last words?
I think we've said it all.
Any final arguments or conclusions?
For me, the only thing I'll say is, for us, it's very important because, we're going new into the market. We're trying to educate people on the importance of real estate and trying to educate them that, buying it the old way is not the best way. So, I definitely think that people because Dubai brings in a lot of money from across the world, right? So there's a lot of feeder markets that come into Dubai and drive money into Dubai. So I think, there's a huge speculation on the market here. And I think, what we're trying to do is bring transparency to that and explain to them that, the market is a fantastic market to invest in right now. You just need to do it the right way. So that's why.
And I'd echo just Nadine's last point. Scientifically, diversifying lowers your risk without lowering your expected return. across asset classes, you're going to be best if you do that over your 15-year time horizon. Going back to your first question,
That's
we've
your
been going
question.
around in circles.
Don't clap yourself to
But I have to
15
say, from a real estate perspective, if I ever buy real estate again or ever invest in real estate again, it's only within the mechanism and the frameworks and the opportunities that you guys are creating. I don't think I would ever do it again in terms of buying an entire property.
I don't blame
Yeah,
you.
it's too much concentration risk.
It's too high of a risk.
And you miss out on other opportunities, right?
100%.
And it's more that it's more that last part for me. It's locking up cash into one kind of asset rather than being able to kind of
And the
do other
headache
things.
of making sure the occupancy
100%.
rate and anyway.
100%.
Anyhow, thank you very much. This has been
Thanks a lot for this.
a great podcast. I really appreciate it. Thank you for taking the time. Thank you for making it.
We'll probably do a follow-up.
I hope everybody enjoyed it and I hope it was useful. The objective was to educate, and nothing from this podcast is investment advice.
Not
Making it
financial
clear.
advice. Yeah,
There's
that's
no
right.
financial advice and no investment advice that you should take away from here. Just information to educate yourself.
We should put that at the start.
Thank you
Oh, yeah.
very much.
Disclaimer.
All right.
Thanks a lot. Thanks, Chris.